our webinar. I'm Emily. I'm on the client engagement team at thinkstep-anz. And I'm really excited to be presenting this webinar to you today as an MC. So I'll give you a bit more information before passing over to our speakers, Brian and Jeff. Before we get started, I just wanted to make an acknowledgement of country. So I'm based in Adelaide on the lands of the Kaurna people. As we come together to share knowledge, we recognise the Indigenous peoples in Australia and Aotearoa, New Zealand, have been observing, understanding and caring for the environment for many generations. We honour the deep knowledge systems of the Aboriginal, Torres Strait Islander and Māori peoples, grounded in connection to land, water, sky and community. Their ways of knowing continue to shape how we understand sustainability, resilience, and the balance between people and nature. I will now hand over to Brian from Cogo. So I'll leave it to Brian to introduce himself.
Thanks very much. Koto everyone. Brian Johnston from Cogo, based in Wellington in New Zealand. And we've got clients across the world, mostly focused on the banking industry, but not only. A couple of bigger ones in Australia. So Westpac, Suncorp in particular, and Data Action coming up soon. I'm going to walk through, and thanks for the opportunity again to speak to this, but we use spend-based emission factors quite a lot. We use this spend-based emission factors to scale impact. Essentially, this is what we really try to do. We're trying to innovate around solutions that will move the dial. But having said that, there are some parts of what we're offering that are quite closely tied to corporate reporting and that side of things. So what I was going to do is just walk through some of those solutions that we've got and just explain a little bit more about how we're using spend-based emission factors. But probably firstly, just a little bit more about Cogo. So just a little delay on the click there. So we're primarily selling carbon footprint management products, and we've supported so far over 2 million individuals and businesses to measure, understand, and reduce their impact on the climate. We're primarily working with large organizations as a conduit out to particularly individuals and small businesses, individuals, homeowners, small businesses, should I say. And yeah, the simple idea that we've got there is we're just helping people to spend in line with their values and make it easier for them to take action in that way. So we're mostly active these days in Australia, New Zealand, Hong Kong, UK, and Europe. I'll walk through our three solutions just from a spend-based emissions perspective. We have three main solutions: Retail Engage, which is focused through banks around personal carbon footprinting; Supply Chain Comply, mostly focused through corporates, although also industry groups and accountancy providers. That's helping small businesses in particular to measure their footprint, but we're also doing some work supporting corporates on spend-based. And Retail Comply, finally, that's an engagement with particularly focused on homeowners and helping people to, well, basically electrify and introduce much more energy efficient solutions in the home. All right. So Retail Engage, this is our personal carbon footprinting solution. What we do here with spend-based emission factors is we make it a lot easier for people to see or get an indication of their carbon footprint. The hardest part in personal space, or if you've got a household and you're trying to think what's my carbon footprint, is where do you get the data? How much time and effort is it to compile a picture? A business is, I guess, these days, particularly larger ones, obligated to go through an accounting procedure. Individuals are not really going to do that. So, how do you give people a picture of what their footprint is so that they can take more informed action, focusing actions where it's actually going to move the dial more for their situation. So whether it be an area like home energy, or in terms of transportation, if they switch from a petrol-based vehicle to an electric vehicle or a hybrid vehicle, how much does that move the dial for their footprint? So spend-based in that way, with the carbon emissions intensities linked to economic activity, is a very easy way to build a footprint and help people to see. We've got solutions in market for a number of companies in a number of countries, and we've been supporting for a number of years now as well. So for us, it's very important that we can update the emission factors. Well, we receive updates and run it through our modeling and out to clients with regular updates. Spend-based also means, of course, you need to factor in inflation. That's also pretty important, particularly in the last few years when there's been quite a lot of inflation and COVID-induced shocks through the economy. And that's something that factors in as well. So we update our emission factors that go out to clients every 6 months. And in New Zealand market, we're using ThinkStep emission factors to do that. ThinkStep's emission factors are updated every year. So our inflation adjustment that we take on additionally in between is something that we need to support our personal footprinting solutions in particular. So that's why we take that action. Okay, second area is what we're calling supply chain comply. It has two components. So the one that's maybe of most interest to a lot of corporates out there, where we're supporting, amongst other players, including thinkstep, to be honest, is around using Spend-Based to get a hotspot scan of part of your Scope 3 carbon footprint, so particularly supply chain reporting. So Spend-Based has a particular use around purchase goods and services, category 1 of the Greenhouse Gas Protocol, as well as category 2 capital goods. Of course, for large capital works projects, there are even in purchase goods and services, other options out there that are probably more accurate, but it comes down to the amount of work that's required, and Spend-Based is a great place to start, essentially. So we're supporting clients with a scan if they're getting started, but equally, we've been noticing, over time, there's going to be more and more discussion around how to hybridize data, and you'll be bringing in more accurate supplier data or more accurate product data from suppliers and so forth. And so how do you put all of that together so that you don't reduce the scope of what you're trying to track year on year? And so we're actually helping some corporates with basically a sort of a gap filling exercise using Spend-Based to complement the activity data that they are collecting that is more accurate. So we map generally to general ledger codes in the accounting system of the corporate. And in the background, I guess, the reason why we're doing some of that activity is to try to drive engagement of corporate supply chains into the small businesses that are in their supply chains. These are always the hardest to engage with, the hardest to try to get data out of, if we want to be as blunt as that. And yet spending with small suppliers can actually, on aggregate, be quite significant. Depends, of course, on your business. What we do here is we use accountancy data integration with AI-based auto-categorization and then encouraging the SME to do more categorization. This is a spend-first approach with activity data then supplementing or being brought in over time to meet the kind of the general expectations that are out there in the market. But spend-based is a great way to give people that first estimate, essentially, to get them on their journey and hopefully motivate them to go further. Just conscious of time, I'll just try to wrap up quickly. The final solution I was going to briefly introduce is Retail Comply. And this is, I suppose, building on some of the work we've done with Retail Engage around personal footprinting, but it's a deep dive in home energy. So, the work we've done with Spend-Based and looking at financial transactions around people's footprint and the home energy footprint, it helps to particularly identify where you've got a large footprint in that space. Like, I guess it's the difference between, do we try to get everybody to purchase an electric vehicle, or should we be focusing on those people that have a petrol vehicle and are driving quite a lot, rather than those that don't actually own a vehicle? So it helps to kind of pre-qualify which customers perhaps the bank wants to focus on, and that's really useful for financed emissions reporting. But basically, the tool is an online platform where a homeowner can come in and enter basic information and get an idea, again, of how much they can move the dial on energy efficiency and carbon footprint reduction, so that they can get started or move faster on their journey. So Spend-Based is not in that solution specifically, but there is the ability to integrate in Spend-Based as well into that over time. This is a quick run through of how we're using Spend-Based. We definitely believe that there's a value in using it for the right use cases, and we're keen to share that message.
Thank you, Brian. So I'm Jeff Vickers, I'm Technical Director at thinkstep-anz, and today I was hoping to kind of go through 4 different questions. So I want to first cover what spend-based emission factors are, what they include and don't include, what the typical use cases for using them are, which I think probably the people in this room already know, so we'll go over that relatively quickly, and then finally our emission factors for the New Zealand market. So a spend-based emission factor, very simply, is an emissions intensity per dollar of spend in a chosen category. So if you've got a commodity or an industry or whatever it happens to be, you're looking at what are the emissions of that thing per dollar. They are very easy to use because you're just multiplying them by transaction amounts, but they are more prone to fluctuation than physical emission factors like burning a certain amount of diesel, because ultimately there is inflation, as Brian touched on before, and that means that your intensity per dollar is decreasing as you've got more and more inflation in the market. They're calculated by taking the total emissions from an entire sector or commodity divided by the total revenue from that sector or commodity, and they consider total annual production for that entire sector in a year. So they're an annualized metric normally. What they include effectively is everything a company spends money on. So if you're trying to think, is this in scope or out of scope of a spend-based factor, just try and think about what a company is spending money on or not. So typically speaking, what that means is that they're what we call cradle to gate. So they're everything up to the manufacturer's gate because that's the money they're spending to be able to produce a product. So the goods they buy, the energy that they purchase, all the other things that they do to make a product or service, that's the stuff that's typically in scope. As it goes downstream through the market, then that stuff isn't accounted for because it's accounted for in someone else's commodity production process. They consider both direct emissions from a particular manufacturer and all the indirect emissions in their supply chain, including the emissions embodied in international trade. But how you handle those emissions depends on the method or provider of that information. So you can do a single regional model or you can do a multi-regional model. They relate specifically to the purchase price or revenue for something, not an organization's profit or a margin on something. They're related to the sort of total monetary flow. What they're not covering is downstream transport typically, unless the company pays for it. They're not typically accounting for the use of something. So if you were looking at a spend-based emission factor for a petroleum product, it might cover the extraction and refining of that fuel, but it wouldn't cover combustion because that would be in use in a truck or in a vehicle or in some other kind of equipment, which would be a downstream kind of sector. They also don't account for end-of-life disposal associated with assets, and that's just something to be aware of. So those sort of downstream emissions aren't accounted for. They also don't account for private emissions and private expenses borne by employees. So when you're looking at scope 3 footprinting, you often consider employee commuting as one of the subcategories. Employee commuting wouldn't be part of a spend-based approach because the company doesn't pay for it typically, unless you had like a fuel card system, for example. They also don't cover intermittent emissions that occur infrequently and wouldn't be captured in a particular year. That generally doesn't matter as you've got a bigger and bigger economy, but for in a smaller economies like Australia and New Zealand, it's more and more of an issue because you've got a small number of large players in some sectors. If we look at this through the lens of the scope 3 subcategories from the Greenhouse Gas Protocol, you've got 15 subcategories divided into upstream and downstream. Very simply, they don't include the downstream categories because the companies aren't typically spending money on that. They include most other things except not all capital goods because some of them might be outside of the reference year and you might not have enough companies in a particular sector to be able to see that sort of spread over time. And they also don't cover things that the company's not paying for, like employee commuting, for example. So in terms of how you use them and where you'd use them, the four most common use cases are corporate carbon footprinting, where you're looking at purchase goods and services and capital goods, as Brian flagged. There's also looking at the carbon footprint of financed emissions. So when you're lending money or investing money, what is the footprint of that? There's research-driven projects like this one from us, where you're trying to understand the footprint of a demand-side sector. So for an organization like ourselves that are involved in quite a few sort of research type projects, spend-based factors are really powerful for understanding the demand side of the economy. A lot of greenhouse gas carbon footprinting work at a national level was done on the supply side, the production side. But if you want to get to a sort of a if you want to get to a demand side sector like buildings, or in this case tourism, then spend-based factors are really, really critical because you want to understand, okay, we know how much visitors in the case of tourism are spending and we know where they're spending, what is the emissions intensity associated with that. And finally, they're useful for calculating the personal carbon footprint, as some of the examples that Brian showed covered. So our emission factors were developed over a period of years and released in 2022 and then updated again in 2024. We also update them annually now as a kind of a commercial license, but we have a freely available version on our website as well for anyone to use. The free license covers the years 2021 and 2018. The commercial license is updated annually. It currently has 2022 data in it, and we're releasing a 2023 update on the 1st of August. One of the poll questions that we had at the start of the session was, do you worry that the data is not up to date? Something to be aware of with spend-based emission factors is that developed from data that's available from public statistics bodies generally. And that data normally has a time lag. So even though we're in 2025 and we haven't yet released the 2023 data, that's just because that's the time lag taken to release the information that we need. It's compiled usually as part of New Zealand, in the case of New Zealand's greenhouse gas inventory, and then there's a little bit of a lag for Stats.nz to compile that into something per sector that we can then use to be able to calculate emission factors like this. So there's always a time lag, and the way you deal with that is through inflation adjustment, as Brian mentioned in his presentation. One of the other differences between our free license and our commercial license is that we split stuff up more. So this commercial license splits emissions into scope 1, 2, and 3. We split things by greenhouse gas, and we split split emissions by what's happening inside the New Zealand economy versus what are emissions imported from overseas. The commercial version can also be used in software tools and has the annual updates as part of it. One of the things that we've done through our emission factors and is common in some others is to cover emissions intensities for both industries and commodities. Most companies are really interested in the commodity emission factors because that's what you're buying on the market. But when you're looking at things like financed emissions, it's sometimes useful to consider that at an industry level. So that's why there's two different sets of information there. It's important to be aware of how the emissions intensities are calculated. So in our case, for the New Zealand market, we're looking at domestic emissions from Statistics New Zealand, and that covers the direct domestic emissions from a particular sector or commodity, and also all of the indirect emissions associated with purchasing stuff through the New Zealand market. But you also need a way to be able to address emissions imported through trade. The way we do that is we use a commercial multi-regional input-output database called EORA, and that database supplements our domestic sort of single regional model for New Zealand to give us the trade part of the equation. The reason that that's so important for a country like New Zealand is because we're tiny and we've got a whole lot of economic sectors that are entirely missing. So New Zealand has a very small textile sector, it has a non-existent automotive sector, and other, there are plenty of other sectors, computer equipment, other electronic equipment that we just don't make at all. And as a result, it's really important to be able to have something to represent that that's not specific to the New Zealand market. Australia is similar, but to a lesser extent, right? And so the smaller the country, the more important it is to be able to represent the imported emissions. And that's the way we handle it for our New Zealand emission factors. In terms of how they look, we deliver them just in a spreadsheet format. It's relatively simple. Basically, it just lays out the commodities and industries available. It lays out the environmental indicators that we're using, the reference year. We have a version number to be able to track it and maintain the emission factors over time. And there's also a sort of inflation adjustment that's built into the Excel tool that we deliver so that you can choose what your reference period is, and it will do the inflation adjustment for you. All right, that's all from me, and I'm going to hand back over to Emily for the Q&A.
That's great. Thank you so much, Jeff and Brian, for your respective presentations. Lots of awesome insights there. We'll move on to our Q&A section now. So the first question that we have is, how can I get my bank to show these carbon numbers in their mobile banking app too? So that might be more for Brian, that one.
Great question. Well, I guess it depends on which bank you're with and whether they have a solution. So I'm not sure. I think the question's more a general question around trying to get this information through onto banking apps so that we can actually all start taking it into account. I would suggest that you reach out proactively and try to nudge and anyone you know that would be also interested in seeing this information, because to be honest, it's hard for banks to assess how this kind of solution might land. Particularly these days, there's quite sort of extreme views pro and against, and what's the role of the banks and so forth. So yeah, as a customer of the bank, then you've got a important part to play in that.
Great, thanks, Brian. The next question is, what is the difference between using annually updated spend-based emission factors, commercial, versus adjusting emission factors for inflation year on year using free ThinkStep product? So Jeff?
Yeah, so essentially the difference is that the data going into it's different. So as part of our kind of annual update cycle, we recalculate all the emission factors. So we take the latest emissions per industrial sector, and then we effectively translate that through to all industries and commodities to give you a kind of an updated number. In the short term, that's probably quite similar to an inflation adjustment because the sector can't decarbonize hugely quickly. There's a bit of a time lag there. But over the longer term, the problem you've got is that an inflation adjustment assumes that the emissions effectively remain the same, and the only change is that things are getting more expensive. That's not normally what happens in our experience. Some of the jumps around when we do, so as part of our commercial license, we have like a change log that we release as well with each update, and it shows some of the shift around in some of the numbers. They're definitely considerably larger than inflation in most cases, and it's just worth keeping that in mind. So I'd say in the short term, if you're not inflation adjusting over a huge number of years, it's probably not a big deal. The longer the time period, the more it becomes an issue because the more you get decarbonisation per sector and also structural change within the economy, which can lead to either decarbonisation or increasing carbon footprint depending on the change.
Awesome. Next question. If we use spend-based emission factors for purchased goods, does it mean expensive products have higher emission results? But in reality, low carbon intensive products normally are more expensive than BAU products. Has this been considered?
Yeah, it's the main limitation of spend-based emission factors. Effectively, you get penalized for spending more, and the only way you can really reduce impact is to spend less or change the categories that you're spending in. So yeah, you're completely right. That's what's happening. It's not really fair. There are sometimes adjustments that you can make. There's hybrid approaches, like say you were looking at spend, and maybe Brian can talk more to this, but if you're looking at high emissions activities like buying an airfare or doing something else, you might like to do a slightly different approach rather than just how much you paid for it. But yeah, it's a kind of a known problem. It is a limitation with the spend-based approach, and it is why typically spend-based approaches are considered a starting point rather than the end point for assessing your emissions. But they are a really good way of screening. But yeah, it's a great point. Brian, did you want to add anything?
So just a little bit of an aside, but on personal carbon footprinting, because we're delivering that 100% with spend-based, it's a bit of an unusual case, but we make sure, for example, that we're able to, with a reasonable amount of confidence, bring in a second-hand version of the emission factor, if you could think, from particular retail, like retail fashion or retail furniture, this kind of thing. And so in that way, give people the ability through spend-based to kind of see an estimate of the difference. But again, it's not specific to the brand or the product or any of that kind of stuff.
Cool, thank you. Still, we've got a few more coming in, which is really good. People have a lot of questions to ask, which is a good sign. So this next question is a bit long. So as a provider of LCA data in the digital sustainability space, working with medium to large global customers, our experience consistently shows that spend-based methods can overestimate Scope 3 Category 1 emissions by up to a factor of 3 using ISO 14040/44 and PEF 3.0. Can you explain the discrepancy? And given that spend based approaches are primarily intended to identify hotspots, would you recommend organizations transition to material based methodologies when specifically assessing the carbon footprint of their information systems and digital infrastructure?
Yeah, it's a really great question. Actually, I might just skip back a few slides. I think one thing that's worth being aware is that the scope of what's considered differs depending on the method that you're using. And so if you're using spend-based, the advantage that it has, it's always got what's considered a complete system boundary. So you're accounting for everything that's every emission that's related to everything the company spends money on. So all services are included, capital goods, everything that has a monetary value associated with it in the economy gets an emission factor associated with it as well. If you're looking at a life cycle assessment based, like a process-based life cycle assessment approach, a bottom-up approach rather than top-down, and keeping in mind, maybe I should just make the point that ThinkStep as an organization, we're primarily a process-based life cycle assessment organization. We do mostly bottom-up work. We just happen to also do some top-down stuff too. What you're doing is you have a defined boundary around what you include, but it's not everything. You always have to cut off something at the boundary. You have to truncate the system. So we typically would exclude any purchased services. So you might not include the research and development department, the marketing department, the sales department. Those sort of head office functions often will be excluded entirely from a bottom-up EPD or LCA type assessment. You also, if we kind of go through this list, you'd say, yes, your purchased goods are included, but possibly not all of your purchased services. Typically speaking, an environmental product declaration wouldn't include capital goods. It would include all fuel and energy related activities. It would include all upstream transport and distribution. It would include waste, but it wouldn't include business travel because it's considered a corporate function. It wouldn't include employee commuting because it's considered part of the employee's day-to-day life, getting to and from work. And upstream leased assets would only be considered if they were relevant, but often they're excluded as part of infrastructure. So I think something that's worth bearing in mind is just they're not quite the same thing, and they're not trying to assess quite the same thing either. And so the reason why input-output approaches, top-down approaches tend to what you might say overestimate, they'd be higher on average, is because they are considering more stuff. And a lot of the work that I've seen, it varies a lot by sector, right? They can be sometimes 30% more, they can sometimes be double. You're indicating 3 times. That's on the high side for what I've seen, but it's certainly there is an increase there. What I would suggest to most companies is that you start with a spend-based approach for screening, which is what Brian proposed before, and then you can look to like a hybrid approach instead, where you go, okay, here's our main kind of emissions intensities. We've got 5 or 10 top purchases that really contribute 80% of our carbon footprint as an organization. So how can we then get specific emission factors for those things, potentially also recalculate your baseline year so that you're making fair comparisons, and then, kind of go from there. Brian, I wondered if you wanted to add anything.
I think probably to a bit of a plug that, we're working at the moment on a bit of a good practice guide around spend-based, and that's all tied to the fact that, I think we're all sensing there's an emerging challenge that's coming with mainstreaming of corporate reporting on scope 3 around how to put together these different data types and still keep it, coherent and making sense, and where the flexibility is, and how we can actually get to sort of comparability down the track. So, waiting for spend-based to get perfect, or LCA to get perfect, or company reporting to get complete and perfect is, that these things are not going to happen. It's going to be a bit messier than that. And it's definitely, it's important, I guess, to take the steps initially that you're taking, bring in more accurate data, and then there will be a need to grapple with kind of how to bring these things together on a consistent basis over the years.
Awesome. It was a team effort answering that one, so thank you. I think that was a pretty comprehensive answer. Now, we do have a few more questions, but unfortunately we are at time, so we will answer those questions and get them out. They'll be uploaded on the website once this webinar recording is live. So thank you very much. And thank you very much as well for Jeff and Brian for presenting and teaching us all today about spend-based emission factors. And if you wanted to contact us or Jeff about any spend-based emission factor stuff, or requesting access to these factors, please use that email address, data@thinkstep-anz.com, that I've just posted as well. So, and yeah, with that being said, thank you very much for your time and have a great afternoon.
We have many more webinar replays on a whole host of sustainability topics. You can check them out on our website and our YouTube channel.